Hello, everybody, and welcome to another episode of Fresh Perspective Planning Podcast. My name is Michael Mezheritskiy. I'm the president of Milestone Asset Management Group. We are a fee-only registered investment advisory firm with a little bit over $220 million under management, specializing in working with retirees around tax minimization in retirement. And joining me is Rich LoPresti, our certified financial planner from our Milford office. Hey, Rich, how are you?
Hey, how are you, Mike? I am doing well.
Very good. The sun is out. The weather is starting to warm up a little bit. We're going to have to do this outdoors one day.
It is nice to get outside. That's for sure. A little vitamin D.
It has never hurt anybody. But I'm really excited to discuss a topic that we've kind of picked out for the day. You know, if you guys, our listeners, that is, if you have a topic that you'd want us to kind of bring onto our podcast and talk a little bit about, just indicate them in the notes and the comments. But we kind of trying to pick something that is relevant to the people that we work with, and we are being asked about this all the time. And I feel that today's topic is a very, very important topic, because if you have ever saved for retirement and you put the money away in the 401k or an IRA, what we call 457, a qualified retirement account, eventually you're going to have what we call a required minimum distribution, an RMD, where you're going to have to start taking money out, whether you like it or don't. So maybe we can start with a little bit of sort of a overview of what the required distribution is, how it works, why we have it. So I'm going to pass this on to you, Rich, if you want to drop down some wisdom over here around that topic.
Sure, absolutely. But I'd like to start by saying, if you have a Roth 401k or Roth IRA or anything Roth related, there are no required minimum distributions, Michael. And that's
a very good point. That's a very good point.
So the required minimum distribution, for those of you that do not know, is the deferred assets that you acquire, the contributions that you put in within your 401k, 403b, as Mike had said, with company match, hopefully. At some point, you're forced to take those tax deferred dollars out. And when you take those tax deferred dollars out, it comes out as income. So it's based on life expectancy, typically on a uniform life expectancy table. If your spouse is 10 years younger, it changes that a little bit because it kind of extends it out. But there's a divisor, and it's usually about 4% or so to start. And then it slowly increases every year. As your 401k grows, IRA grows, the distributions get bigger and bigger. And in the past, it used to be 7.5 was that magic number. Then it moved to 72. And then if you're born before 1950, I believe it's 73. And if you're born, I guess after that to 1959, it's 75 is the required minimum distribution age.
Yeah, that's a favorite topic, because required distribution is something that is absolutely forced upon you. And, you know, as Rich said earlier, prior to 2020, 2021, the required distribution age used to be 70 and 6 months. And as life expectancy got longer and people lived longer and still are living longer and longer, because medicine is getting better and better and better, they've actually decided to push the required minimum distribution age, which basically allows you a couple of extra years of tax deferment. Now, they did take some things away as a benefit from that. They took some of the things away, right? There's no free lunch, right? So they've decided to extend your required distribution age. They said to the IRS, that is, the government, came out and said, hey, listen, we're going to give you a couple of extra years of deferment, but we will take away some of the beneficiary options, which we'll definitely get to in just a second here. But it was definitely a questionable decision whether or not getting the extra couple of years of deferment is worth the loss of what we call a stretch provision. Rich, do you want to tell us what the stretch provision used to be and what it is sort of now, the new version of the stretch provision?
Sure. So the government basically wants to get their money at some point. So they added a few years again to your distribution age to get a few more years of that growth in. But what Michael is alluding to is that non-spousal beneficiaries used to be able to stretch that out over their lifetime. So if you passed away and your spouse is alive, the funds flow to your spouse and it gets continued to go, over her life expectancy, the withdrawals that is. But if it's a non-spousal beneficiary, like a child, they now have 10 years to take all of those funds out, right? So from their lifetime, so say they were 40, 50, 60 years old when they inherited those assets. So they had another 20, 30, 40, 50 years to take those assets out. Now they have to take them out in a 10-year period, which ultimately puts them in a higher tax bracket and gives the government, in essence, more of those tax deferred dollars that they allowed you to save on a tax deferred basis all of those years.
Yeah, pretty good deal. So when you passed before 2021 and the kids inherited the accounts, they just go in, they continue on with the required distributions, but they can continue to defer the money. They just let it go. When they die, the grandkids get it and keeps going and going and going and going. But now they got to take it out within 10 years, which creates an enormous tax burden on the kids. And guess who wins? Like the ultimate beneficiary in this whole process is our federal government, right? I mean, that's really who could potentially win quite a bit here because of what are we at? 36.6 trillion in debt as of April 30th that we are recording this particular podcast.
Yep. Yeah. I mean, not to change subject, but there was one other benefit, I guess. In the past, if you missed taking your required minimum distribution, the government would penalize you 50% of that said distribution. So now they lowered that to 25%. So if you miss your mandatory distribution, you get a 25% penalty. But they reduced that penalty, which is kind of interesting, to 10% if you correct it within 2 years. So kind of the government being nice there to you.
They really are. They seem to really care. But I digress. So let's just get back to the required distribution. What we see a lot, because we work primarily with people who are retired or about to retire, getting closer to it. So if you are starting to think about retirement planning, if you're starting to say, "Gee, I'm a 5 year out from potentially wrapping up my working career," and you start to reach out to some financial planners, if you are not looking down the road to see what required distributions could potentially do to your income taxes, you're really missing the boat because when you could retire, and we see this all the time. People work, they earn a certain amount of money, then they retire, and the bracket drops all the way down to 10, 15%, right? Because they're not really earning any money. There's no income. So Social Security is not taxable to you at that point, or if it is, a very small portion of that. And you don't have IRMA. So IRMA is an extra premium you pay on top of your Medicare because you make too much money. So that goes away because you're not making any money. So you're sitting there at a high school level tax bracket, right? You say, "Gee, this whole tax deferment business was great. I saved on taxes when I was working at a higher bracket. And now that I'm retired, I'm at a lower bracket and I'm living a good life. I'm getting all the refunds." And that lasts for, what would you say, good 10 to maybe 12 years. It's a very short-lived uh, victory, if you want to call that. Because as soon as you get to that 73 or 75, and that required distribution comes out, Rich, tell me, what is going to happen to your very basic 1040?
Mm. Well, since you're forced to take out more income, your required minimum distribution adds to the income that you currently have coming in. And even if you don't need that income, you have to take it and move it to a different account, not spend it or spend it, but it puts you into a higher tax bracket, Michael. That's the answer that you're looking for, I think.
Yes, yeah. So then the terminology, the number that the IRS is kind of looking at to determine your taxable amount is called provisional income. That's the actual terminology for it. And provisional income includes basically every penny you get. Do you have tax-free municipal bond funds? Guess what? Their yield goes into your provisional income calculation. So at the end of the year, you have amount of money that comes in, and required distribution becomes part of that amount. And then they look at it and they say, oh, you have taken a very large required distribution, say of $1 million. Your required distribution could be 30, $40,000, depending on the calculations at the time. And now Social Security is taxable to you. 85% of that could potentially go back on your taxable income. Guess what happens to IRMA? The Medicare premiums. They shoot back up, right? And so is your long-term capital gain. It impacts everything under the sun. And guess what? Can you do anything about it at that time?
Unfortunately, not at that time, Michael, because you're forced to take it out, and it's kind of too late. That the ship has kind of sailed on that one.
Yeah, you kind of missed the boat. And again, there are some tax opportunities that could still be available to you, depending on longevity in your family and sort of, maybe you want to do some more planning for the kids and so on. But at the end of the day, your golden opportunity to do something about your required distribution really comes in right before you retire or right after you retire, somewhere in what we call gap years during that period of time. But required distribution never goes down. As a matter of fact, when we run our calculations, we usually see that when you start collecting your required distribution, within 10 years, it almost doubles, which is quite a bit of money that you actually might not even need. But guess what? You got to take it. You don't have to spend it, but you absolutely have to pay income tax on it. And they never, because we can put up a graphs. One of the things that we do, one of the systems planning softwares that we use allows us to see the trajectory of required distribution over your life expectancy. Have you ever seen it decline?
Yeah, well, it's almost impossible for it to decline. I mean, it can decline, but it goes up, every year, right? So it's based off of your December 31st balance of the prior year. And the way that it's calculated, Michael, is that you basically take that balance and then you divide it by the divisor that's in the uniform life table, and just say, at 75, it's 22.9. On a million bucks, that's almost, 50,000. And then the following year, the divisor goes down to 22. 10 years out, it's at 15, right? So you're taking more and more money. So, I mean, even if the market goes down, technically you can pay the same or a higher RMD based on the amount that you need to take out.
Yeah, it never, it's not designed, to go down, and it's designed to really be a tax horse, and a revenue sort of source for our internal revenue services. Our government needs the money, and if you're not planning for that in your 60s or even in your 50s, you're gonna miss the boat when you are in your 70s. Now, many of our clients are married, but we're not going to be here forever. No, none of us are going to make it out of here alive. That's a guarantee. That and taxes, right?
Good news, Michael. That's a fresh perspective.
That is absolutely a fresh perspective.
Pushing up daisies.
That's right.
Uh-huh.
Uh, Rich, so what happens when you lose a loved one, a spouse passes away? How is that impacted? By the way, what is it actually called? There's a very interesting name to it, and how does it impact their taxes?
Well, the widow's penalty, is that what you were referring to?
Yes, yes, yes,
Yeah.
yes.
So the RMDs continue, and now not only to take yours, you take your spouse's RMD. So they're basically combined. And what Michael is alluding to is that your tax bracket shrinks. So you pass away at 80, 85, and now your spouse is, they're all alone. And the way the government rewards them is putting them into a single tax bracket. So you were a joint filer, right, when you're married, and you have a bigger bracket. So that just means
Yeah.
that, let's just say the 24 bracket goes out to like 400,000, right? Well, that same bracket now only goes out to like 200,000 because you're just one person. But guess what? You're getting the RMDs of 2 people, so it puts you in a higher tax bracket, and your taxes actually go up. So it's kind of a not a very nice thing to do typically to an 85-year-old woman, for example, unless she remarries. I don't know. It's a possibility these days. So
It could be a tax planning strategy, but in all kidding aside, when you do pass, your surviving spouse becomes a single filer, and then, as Rich said, the bracket goes up because you have much less income that you can put in into the same bracket because it's just one person. But the biggest issue with all of that is that, remember, provisional income. We talked about this, a few minutes back. You're going back to the highest potential Medicare brackets. Your IRMA goes up, your Social Security is at 85%. So it's
yeah,
impacting everything you're getting along the way,
yep, big
which
domino
is
effect.
huge, huge domino effect. And that's essentially what they're kind of planning on. So, we run retirement planning classes almost every month. And last time, it was actually 2 months ago, I had somebody in one of our classes that came to me afterwards, and she said, Mike, I'm 74, I'm a widow, and I'm living this nightmare that you're talking about. I wish more people would take action, uh, because it's a real problem. And, you feel like, oh, 74, 73, that's so far away, but it'll be here before you know it.
You know, it's good to have a plan. It's again more about playing chess than just looking at what the current year is. You need to look out and see how things are gonna unfold. Based upon what we know, what current tax law is too. Because like you said, we have a lot of debt in this country, and one way to kind of reduce that is by taxing us more, right? So
Yeah, and taxes are scheduled to go up right now, right? So right now we have what's called the sunset provision at the time of this recording in April of 2025. As of January 1st, our taxes are scheduled to go up already. Now, I know there's a lot of talk about current administration potentially extending it or not. Doesn't matter how you feel about it or not. The fact of the matter is it hasn't happened. And until they come out and say that, okay, we're going to keep the same brackets for an extended period of time, and we're going to kick this can down the road, we are already seeing an impact of taxes going up, and it's happening in January. It's
right,
only a few months away. That definitely will be here before you know it, and there's an enormous upswing, and what everybody's paying.
yeah, yeah, I agree, and I mean, I think this is a high class problem to have, right?
Sure.
But you don't want the government to be getting the most of your money or being the biggest beneficiary or paying higher in taxes. If you can pay less in taxes, it just makes more sense. If you can pay less in or less in Social Security, etc. But if you have $500,000, it's a pretty decent problem. If you got $1 million right now and you're 55, 60, that's an even bigger problem. If you got $2 million, it's an even bigger problem, because one of the episodes we had you can look at, we talked about compounding,
Hmm.
Michael. So you're not going to spend all of that money in retirement. I hope you do, because then it'll be a fun retirement. And that would be a good reason to have worked to, 30, 40 years. But if you have $1 million, we can take it, in a 10-year period from 55 to 65, that $1 million at a 7% rate of return could double to 2 million. And then 65 to 75, that 2 million could double to 4 million at just a 7% return. You see where I'm going with this? And now 75, now you're 85, that 4 million become 8 million. So these are the taxes you're going to be having to pay, because someone's going to have to pay them. It's going to be you, it's going to be your family, your spouse. So I don't know. I think it's very, very, very important to get ahead of this.
Yeah. So basically, what you're saying, the more you make, the more our government makes, right? That's
Yeah, your
the happier
partners,
they are.
your partners. So
You
traditional
guys are
IRA, you're
together on
partnering
this.
with the government. Roth IRA, you're by yourself, which is good.
Yes, which kind of brings us to, so one of the things I've been thinking about at this point is that, well, what is it that we can do to try to mitigate this? Now, again, this podcast is educational in nature, right? This is not advice, right? You have to have a plan. You have to make sure that the plan works for you. This is just a compliance page so that you guys don't run out and start doing things just because you heard us talk about. everything that we're going to discuss in just a second, we go through a very rigorous process of calculating. We have tools, we have systems. Between Rich and I, we have 50 years of experience of doing this. So there's just a lot of caveat before you start doing any kind of tax planning. We also have an accountant and stuff. So there's just so many different variables that we go through and check off before we go in and do any kind of implementation for clients as far as tax planning is concerned. But now that all this legal mumbo jumbo is out, so Rich, tell us a little bit about some of the steps that somebody could take. Somebody's 55 years of age right now, saying I'm about 5, 6 years away from retirement. I have about $1 million in my retirement accounts. I hear what Rich is saying. The rule of 72 is a thing. I'm projected to have quite a bit of money when I pass away. How do I try to develop a plan to try to mitigate some of these taxes, and what should that plan be involved with? What should I be looking at?
Well, it's basically developing a plan to pay your taxes on your own terms, right? You pay as much as you want now by what Michael's alluding to is a Roth conversion. So we would want to analyze what tax bracket you're in, how much room is in that tax bracket, how much room maybe is in the next tax bracket. And if you do have the liquidity, the flexibility, and the ability to, do a Roth conversion, because no one wants to pay taxes. And it's like, okay, Rich, well, why do I want to pay $25,000 in taxes on a $100,000 conversion this year? Well, that's just kind of what I said. You have 10, 20, 30, 40, 50 years of compounded growth. Well, I rather pay taxes now on the seed of that as opposed to paying it on the big oak tree in the future in 40, 50 years. But again, you develop a strategy, a plan, oversimplified it, where we figure out how much should you convert. Is it 50,000? Is it 100,000? Is it a 200,000 per year, for the next 5, 6, 7 years, so that you are in tax-free accounts in retirement? Do I convert the whole thing? Do I convert a portion of it? How does that look? But we're just scratching the surface here, but it's a very powerful, powerful account, tax-free account.
Yeah, and it's very effective strategy if you have the right plan. We have some people that come in that we meet with where Roth conversions are not as helpful. They might still choose to do conversions because, we talked about the stretch provision, right, being eliminated. So, well, I don't want my kids to suffer this huge tax consequences when I die. So maybe I'll do some conversions myself. But the process of converting assets, what we try to do is we try to look down the road and say, well, what is your required distribution going to look like? What bracket are you going to be at? When you start taking those required distributions, assuming you live a normal life expectancy, how much would you pay in taxes projected, right? We have very conservative growth projections, 4.5%. So we're trying to computate that. We have tools that allow us to do that. And then we go back and say, okay, well, if you don't do any planning, whether Roth conversion or anything else, this is what we're projecting out that you'll pay in taxes. And with being fairly conservative. And then we go back and say, well, what if we know we're going to be at 28% bracket when you retire? Does it make sense to pay 22 on our terms, 24 on our terms? Does it make sense to prepay our taxes now? And then, like Rich said, today is the day where you're going to have the least amount of money for the rest of your life. It's a fact. Market goes up over time. It never goes down over prolonged periods of time. So today is the poorest you will be as far as your retirement accounts are concerned, right? So does it make sense to go in and compute that? Okay, if I do conversions over the next 5, 6, 7 years, and I'm trying to target a certain bracket, how much money am I going to pay in totality on taxes? And what rate of return do I need to earn to break even? When do I break even? How much money am I saving compared to not doing conversions and kind of letting government dictate to me when, how much, and what I have to take out? I don't know about you,
Right.
unless it's my wife, I don't have people tell me what to do with with our money, right?
Yeah, that's a good one. Hope she's listening.
I hope she's listening, so I'm gonna have to send her the link to this episode. Um, but this is the truth, right? I mean, we're completely at the mercy of the government. 5 years from now, they decide to come in and say, you know what? I think we haven't looked at the mortality tables for required distribution for so long. We should tweak it.
Yep.
And when they do, and in my 25 years of doing this, I have never seen that really benefit the end user. It always goes somewhere else. Let's put it this way.
Hmm.
You have no control, right? You have no say. They change it, they tell you what the bill is, and guess what? You have to follow through. So, conversion, wouldn't you say sometimes if you can create a plan, put a place strategy, it makes a lot of sense many times to actually pay your taxes upfront, take your medicine, because what
Yeah.
happens to your bracket after if you have a successful plan, we've done the conversions,
Yeah.
what happens to you afterwards once you've done converting? You at the 0%
Yeah.
bracket for a while or
You're
10%.
broke.
You broke as far as
You're
IRS is
broke.
concerned. You have no income.
Right. Yeah. And I particularly have a lot of clients who are approaching retirement and say they're going to retire, and they first come and they say, well, maybe I will wait to do a Roth conversion until I retire. So I'm in a lower tax bracket. And, some of these folks have been with me 3, 4, 5, 6 years, and we've been doing conversions. And guess what? They said they're going to retire in 2 years and they haven't retired yet.
Mhm.
Right. But they're working and they're able to pay the taxes now, as opposed to when they're retired and they want to spend less money. Well, they already paid the taxes on those assets. Um, I do a silly calculation example for my prospects or people who come in front of me as far as retirement planning, and all they have is tax deferred assets, because that's what most people do. Is they don't really have a lot of savings. Some do, but mostly everything's in a tax deferred bucket, not a tax free, not a taxable, a tax deferred bucket. Well, I say down in retirement, well, when your daughter's getting married and you want to help them get a house, and oh, and by the way, your roof leaks and you need a new car and you need to take $100,000 out of your accounts, right, to live off of. And I say to them, well, how much do you think you're going to need to take out? And they're like, well, I don't know, 100,000. Well, you have to pay taxes on it. Oh, okay, well, I'm in the 24% bracket, and just say I'm in a 6% state, even though the state of Connecticut is 6.99.
Yeah.
That's a 30% effective rate, Michael. So they say, oh, 130. What they don't realize is that they have to take out even more than that, because they need to
Yeah.
pay the money that they're paying the taxes. They need to pay taxes on that. So that's 142,000 that they need to take out. And there's no real tax efficient strategy around that, unless it's, December 31st and they can take out half in this year and half next year and kind of spread out those taxes. But it's just a nightmare, because you'll have absolutely no control over your taxes in the future if all you have is a tax deferred bucket.
Yeah, it was $36 trillion plus in debt. I mean, that the only logical approach here is to raise taxes. I haven't really seen a logical plan from really anybody at this point in time that says, okay, well, here's how we actually going to tackle this, and here's how it's going to be successful. So I'm a big believer, and I know everybody at Milestone is sort of on the same page, is that taxes are going to go up. All of our clients believe taxes are going up, and being proactive with
Yeah.
your tax payment, right? Taking the reins on it and saying, I'm just gonna do it my
Yeah,
way.
I'm not sure the External Revenue Service is going to save the day, Michael. So I'm just saying.
Yeah, I don't disagree with you. I don't disagree with you. But again, at the end of the day, Roth conversions, just like I said earlier, they don't work for everyone. You have to have a strategy. You must have a plan. And if you're listening to this episode and you say, "Gee, you know what Mike and Rich are saying kind of resonates with me. I've been thinking about it, I've been reading about it, but I can't really put it together." Just feel free to reach out to us. We'll have our information in the show notes, our email, our
Right.
website, our phone number. Just give us a call. We don't charge for complimentary consultations. Just come on in. We're fiduciaries, so we don't have anything to sell you. And we'll put together a high level plan for you and tell you whether conversions make sense for you or not. And then you can decide on what you want to do with that information. But there's a lot of stuff around conversions and sort of how they can be effective, but
Yep.
very little of that is useful, wouldn't you say?
Exactly. Yeah, I mean, your situation is different than everybody else's, and that's why it's an art and a science, and it's something that you would want to have a real definitive plan for, because there's a lot more to it than just converting over. from a traditional to a Roth paying taxes. It's the investments. It's all the different things, the timing of it. Like right now, are things on sale? Maybe at this recording. They're not as cheap as they were 2 weeks ago. Could they get cheaper? I don't know. But if you have a definitive plan, it really doesn't matter what the market is doing because we're going to be doing it over time. Because directionally, it makes a lot of sense.
Oh yeah, it does. And listen, we can always get in. Maybe we'll do it in our next episode around asset location. That's a very, very hot topic. Very big for our clients because 60/40, if you have four different accounts and you have a 60/40 asset allocation, well, depending on your tax registration, your tax bracket, and your allocation of the assets would be different than somebody else who has a different tax bracket. So there's just a lot of
Yep.
added benefit that you can bring with it. But
Perfect.
at the end of the day, the clients that have gone through the conversion process with us, instead of on the other side of that, I will tell you this much. They are sitting at the lowest possible IRS tax bracket. They're not paying income taxes on Social Security. And they have the lowest Medicare premiums, and they have quite a bit of money sitting in the Roth account. That, by the way, when they pass and it goes to the spouse, there is no widow's penalty anymore. There's no distributions. She inherits or he inherits, moves along, lives their life. When they pass and the kids come in, yeah, they got a 10-year rule still, but guess how much they have to pay in taxes on those distributions?
0.
Zero. You're 100% correct. So they would leave it alone, take a small required distribution, but leave it alone, take it all out at the end of the year. It's a very effective estate planning tool as well, because this is a great way to bypass the IRS. And listen, I'm all about paying taxes, but you got to pay your fair share. And if there's a strategy that makes your family wealthier, goes more of your hard-earned money goes to your beneficiaries rather than the government. I don't know about you. I feel pretty good about that.
Yep. It's a positive domino effect in this case. So
Well,
no,
very
no
good.
required distributions from a Roth. I
No
repeat,
required
no required
distributions.
minimum distributions.
It's
You
a
control
beautiful
your
thing,
own money, how and when you want to spend it. So,
right? You can take $500,000 out of the Roth account and you have no impact on anything else. Again, it doesn't always work out like this. It's an ideal situation, but if you start planning early enough and you have a process in place and you work with somebody who understands this, because this is all we do day in and day out. You can definitely get a pretty, very, very good plan that's very impactful to you and saves quite a bit of money to you and your family. Um, so as we conclude this, we like to keep our episodes around 30 minutes. I thought this was a very cool and hopefully helpful topic to cover. We haven't discussed required distributions in such a great detail, and sort of how that works and what it does. Any parting wisdom words, my friend, before we wrap this up?
no, just no required minimum distributions in a Roth. And if you're not in a Roth, you're probably going to pay, you can probably take out millions from your accounts, believe it or not, over your lifetime and pay a hefty amount of taxes. So something to consider, explore. And again, we have the ability to run projections and run different scenarios and kind of test things out to see if something like this would make sense for you and your situation and your family. So
Yeah, well
have a
said.
plan.
That's right. That's right. Well said, Mr. LoPresti. It was fun chatting with everybody, with you, Rich. Thank you, everybody, for listening in. We'll be back in a couple of weeks with another, hopefully educational topic for you guys to listen to. But outside of that, everybody have a great rest of the day, and we will talk to you soon.